Hi, I'm James Robinson, and this is my stock pick of the week. So this is my third part in my series on BlackRock, and today we're going to talk about balance sheet. Before I go any further, I want to apologize for the quality of the video and the quality of the sound. The coronavirus, amongst other things, has made it so that my iPhone doesn't seem to work, and I can't get into an Apple store to get it repaired, and I shoot all these videos off the iPhone. So I'm using the screen on my computer, and it's just not nearly as the screen camera on my computer. It's just not nearly as good as it is. So hopefully you'll forgive me, and we'll get back to better quality in future videos. So when I look at the balance sheet for a company, what we're really looking at is the company's ability to withstand bad times. Obviously, that's very apropos now. It's obviously these companies that we're looking at are all going to be tried, and they're all going to have issues with cash flow and other things as a result of the coronavirus. And that's the reason that I spend time doing this research. Every company is great and doesn't need a balance sheet in the good times. And every company sooner or later is going to experience bad times. So I really do think you should take some time to look at these videos. It's funny, but as I look at the videos that are the least watched, it's these balance sheet ones. And I kind of chuckle to myself because I think they're really missing the real silver lining and the real foundation of the company. So anyways, going forward, you can see that BlackRock has done a great job. This is cash equivalents of marketable securities. That's money that this company can get its hands on within, really instantaneously. Marketable securities a few days. And you can see this company has built up that number. The only time it really went down, and it didn't only went down marginally, was from 2009 to 2010, and a little bit between 12 and 13, but basically it's gone up every year. It's pretty stable. So this company has found a good way, as its operations have grown, to build its reserves and grow its reserves. So very, very comfortable, even through this pandemic, that this company is able to support itself. If you remember, the company has about $4.5 billion, $5 billion in debt, and they have over that in cash. So debt isn't going to be a problem with this company, and more importantly, they can likely go and borrow a bunch more money if they need to. So here you can see the company's current assets, that's the blue line, and you can see the company's current liabilities and capital leases. Current liabilities and capital leases is payments they have to make in the next 12 months. You can see here this company's done a fantastic job. They've got all kinds of reserves. If they had no money coming in, they could pay all of their current assets and obligations for a couple of years into the future. And that's one of the reasons why I really rate this company one of the 5 or 6 best companies I've ever looked at, because on top of its income earning capabilities, it's also very, very safe and very, very conservatively financed. So the next thing is, when your company has a lot of debt, that debt manifests itself in a number of ways, but one of the biggest things that it does is it creates an obligation to pay interest, and that's a negative cash flow event, and it's a negative cash flow event that can't be deferred. So you can oftentimes slow down research, or you can lay off employees, but the banks don't want to hear you don't want to pay them. So your interest obligations are they're sacrosanct. You really can't not pay those. The result of that is that companies that have a lot of debt in the bad times will find themselves swamped by their interest payments. It doesn't matter what they do, they simply can't meet their interest payments. They end up being forced into bankruptcy or having to make compromises that they wouldn't otherwise make. So here we look at this company's interest expense, which is the blue line. We look at the company's interest income, which is the money that they're making off these fantastic reserves they have, and you can see they start to balance each other out. They do have net negative interest obligations, so they do owe more in interest than they receive in interest income, but it's not as bad as it might otherwise be, and it's certainly not enough that we would be concerned about this company's ability to pay their debts. That's demonstrated by the next slide, which is interest expense as a percentage of operating income. I don't really want to see a company's interest expense be more than 15% of a company's operating income. As long as it's below that number, it's very, very manageable. If it's above that number, it starts to be a concern for me. And here you can see they've never really been above 7%, and it's safely below that number now. So this company does a very, very good job and is very, very consistent in the way it manages the interest expense relative to their operating income. So this slide looks at total current liabilities, which you can see have been very, very flat since 2011. That's a great sign, especially. So you can see that the company's total current liabilities and total long-term debt. You can see that the company's total long-term debt has been pretty flat since 2015. The company's total current liabilities, again, that's current liabilities is money you owe in the next year, and long-term debt is everything that's more than a year out. And you can see that their current liabilities have been basically flat since 2011. And so you look at that and you say, okay, very stable company. They're not borrowing much money. They don't seem to have additional needs for cash. So again, just more and more reasons to be comfortable with BlackRock. One interesting thing that we should be considering, especially in rough times, is the interest coverage ratio. So the interest coverage ratio is the measure of the company's ability to meet its interest payments. And here you can see the equation for how we figure it out. But long story short, it's earnings divided by interest expense, and you like to have the earnings be a significant multiple of interest expense. So let's look at how BlackRock does in this category. It was basically their interest expense, and so I like to see an interest expense of about 2.5 times, interest coverage ratio of about 2.5 times. And the company was sort of bumbling right along that number until about 2010. And then in 2010, they started to really make money and really put some money away, and their interest income, their earnings were increasing every year, and their interest really wasn't. And so you can see that now I like to see it at 2.5 or 3 times, and this company is up at 8 times. So it's 3 or 4 times what I like as a margin of safety. So just another reason why we think of that interest coverage ratio, total interest, and the amount of debt for this company are indications of the company's strength, and in many cases for companies, their areas of weakness. Another metric that I like to look at is years' income to pay off long-term debt. And the idea here is that if you have so much debt you effectively could never pay it off, that means that your debt is too high. On the other hand, if you have so much debt, or so much income that you can pay off your debt anytime you want, then your debt is pretty irrelevant in terms of risk to the shareholders. And so I like to see, about a 3.5 or 4 times income, 4 years of income to pay off debt is sort of the highest amount of debt I like to see. And while in 2009, during the recession, this company flirted with that number, they've basically been below that number all the time. And for the last few years, they've been really kind of 1.5 or 2 years earnings to pay off all of their debt. So the debt looked at through, every filter I use to look at the debt for this company, I come up with another reason to be comfortable that this company has a reasonable and acceptable level of debt. So that does it for the balance sheet for BlackRock. Again, I apologize for the quality of the video and the quality of the sound, but I wanted to get this video out and get it done because it's kind of part of this series. And so I just said, screw it, we'll make do with what we have. This is a weird time, and everybody hopefully will get it and understand it. And when AT&T sends me a new phone, which they're doing in the mail, then we'll go back to better quality and kind of forget this ever happened. Thanks for your time. I hope everything is going well where you are, and you guys are all safe.